Uh, Hello, everyone. I'm very excited that you're here and I'm here. I hope you're doing well. And we start our lecture. Um, you remember that the previous lecture, we started the main part of our course. We set the main goal, and it was to model the financial market. I mean, the dynamic of the financial market. And we assumed to model the financial market means that we need to model risky asset, riskless asset, and to evaluate price of derivative. We assumed the efficient market hypothesis. You remember about it. Mhm. And we started from the one period binomial model. One period binomial model, it is just a part of multi-period binomial model. And we suppose that the initial price is given, the multiplier factors are given, it is U and D, and probability space is given. It is like only two scenarios are possible, and there are some true probabilities of these scenarios. U and D mean that the up scenario, the initial price, we need to multiply it by U, D, it is like in down scenario, we need to multiply the initial price by D. And we have the risk neutral interest rate. And it is we describe the market for stock prices. What is about the derivatives? It is, for example, call option is given, and we know the strike price of this call option. After that, we considered two approaches. The first approach is for this one period period binomial model consists in formulated the risk neutral measure. It was a probabilistic approach. What is about it? It is about that there are risk neutral measure which provides the mathematical expectation of discounted profit zero. Yes, it is the main result of efficient market hypothesis. In average, mathematical expectation of the discounted profit just zero. And from formula 1, we can get the formula 2. And this formula means that doesn't matter if we invest our money in the bank account, bonds, yes, our is zero, and at the end of period we have this amount, or we invest our money in the stocks, and at the moment t equals 1, final moment, we have mathematical expectation because mathematical expectation of this two scenario respect to these probabilities. Yes, you remember. So from this equation, we can find risk neutral probabilities. So risk neutral measure differs from this probabilities because it is like true probabilities, but this is it's risk neutral probabilities. What is about derivatives and their fair price? The derivatives, fair price of the derivatives, we can found like discounted expected payoff, discounted expected payoff from call or put option, some mathematical expectation. So if payoff it is, for example, 5 and 0, and we know this probability of up scenario and of down scenario, we need just multiply 5 for this plus 0 on this. Okay, you remember this. And we figured out about the condition of the existence of risk neutral measure. And this conditional is that 1 plus r is risk neutral interest rate, no, interest rate, should be more than d and less than u. And I remember that you asked me where we can take d and u. And it is material of our future lectures. Okay, today, okay, and it was the first way how we can find the fair price of derivative, and the second way, which we learned the past lesson, was about the arbitrage method. We formulate what is arbitrage. It is conditional to get a positive profit without initial capital and without risk. Yes, you know, maybe arbitrage like a situation where you can buy and immediately sell the same or similar product at different prices. Yes, more. In this way, resulting risk-free profit. And in real world, this scenario, this situation can be, but it is in very short period, not for long period. Yeah, you remember. And if we use pricing by the absence of arbitrage, you see that we get the same result, that the fair price of call option equals 2.757. So it was interesting. And today will be more interesting because today we are going to consider the third way how to calculate, how to evaluate the fair price of any derivative. And this approach is called a replication approach. For this, I need to define what is the investment portfolio. What is the investment portfolio? Because we are going to replicate payoff function of our option as payoff function of investment portfolio. Okay, investment portfolio is simply a collection of assets characterized by name, number, and orders. You see the formula 10, it is like a vector, yes, and you see that this vector has the coordinates. What does mean these coordinates? The first coordinates with theta with zero, up zero, yes, up zero, is an amount of non-risky asset, cash bonds, but all rest coordinates are amount of risky asset of the different companies. For example, theta 1 equals 5, and it means that we have in our portfolio five stocks of the company no, Google. Theta 2 equals 25, and it means that we have 25 shares of the company Amazon, and so on. Do you understand what is investment portfolio? Yes?
Yeah.
Okay. Um, in this definition, these coordinates can be with plus and with minus. So we need to think what does mean a negative value and in theta zero, because it is like cash money, and this is theta 1, theta k. It is how much we have different asset. What do you think with plus and with minus? If we have,
Sorry, what was the question? Can you repeat, please?
the question is this, Q1 and Q2. What does a negative value mean? Or theta 0, theta 1, for example. No, and what does a positive value mean?
Mm, Maybe if it's negative, then, for example, some companies, I don't know how to say,
Mhm.
how we call it, actia of the company.
Stock.
Stock, yes. Maybe some companies' stock, they really fell down, so that we are going like a minus. And
What does mean fall down? It is like price fall down.
yeah, the price of one stock.
No, no,
No. Mhm.
with minus. No, I don't know. Maybe it's strange for you. Um,
Uh, Maybe
with
it's
minus.
something like debt.
How it's portfolio with minus, yes. Okay, so I need to explain. The first coordinates, it is like cash, yes, cash, and with minus means that we borrow in bank. So for example,
Okay.
mhm, mhm. With plus it's our own. But rest of coordinates, the positive and negative means long and short positions. Yes, you have heard about long and short positions. What does these positions mean? Long and short. Long position. It is position of buyer of or seller.
Seller.
Long or short.
Sorry. Long is the buyer and short is the seller.
Yeah, you're right. Because if you sell something, so it's short position. You sell and forget about it. But if you buy, so you are waiting. You are worrying about the price, yes? If this price go up or go down. Okay, so the answer is that theta 0 plus it is invest or our own cash. With minus it is borrow. And about stocks price, it is like long and short position. So if with minus it is the position of seller, and it is short position, and this is it is position of bar, it's long positions. Okay. Let me explain a replication approach in terms of only um, uh, two coordinates in this vector. So the first you remember it's amount of non-risk assets as always, and theta 1 it is amount of risky asset, and we know this price as. So we can to compute the wealth of the investment portfolio at the moment t equals 0. For example, we have 50 euros, 50 euros, it is this, and we have two stocks with initial price, for example, 17 euros. So today I can evaluate my the wealth of my investment portfolio like 140 plus 50, 190. Okay? Yeah,
Yeah.
thank you. What should be at the end of the period? What should be at the end of the period? You remember that it is a risky asset. So if the price, initial price is S, so final price can be or S multiplied U or S multiplied D. Only two scenario because it is binomial model. Only two scenario. So if I say to you that the initial price is 17, for example, 17, yes, 17, and this it is, for example, 80 and 60, for example. So the wealth of my portfolio at the moment t equals 1 has two values because there are two scenarios. In this scenario, it should be theta 0, it is 50, yes, 50 multiplied times 1 plus r plus 18 multiplied, no, I don't remember, no, to how much, what is number, and to this. But it is clear, yes?
Yeah.
Yeah, okay. Clear, clear. So what is the idea? What is the idea of this method? What is the idea of a replication approach? It is from previous slides, yes, that at the final moment, we have two scenario, and from the cash we have this amount of money, and from the stocks we have this amount of money at the up scenario, and this is at the down scenario. From the other side, we have call option, and at the final moment, t equals 1, your function can be or s multiplied to u minus k or 0. As u multiplied k, it should be if what is conditional for the up scenario? What do you think? So this it is s, this s multiplied to u, this s multiplied d, and we have k. What is k? Volodymyr, what is K? Do you remember?
It's call option price
Yes,
premium.
yes, no premium, no. It is for call option price, but not premium. But what is
Okay.
this? So you are right from one side and you are wrong from other side. Artem, do you remember what is K for call option? What is given for call option? If we buy,
No, it's the what price will be on like break-even point.
not break-even point, not exactly. It is, but it's connected with this point. How it's called? Let's remind what is, for example, call option.
Taking the definition, a call option is like a contract that gives the buyer the right to buy some asset, for example, stock, at some price or some fixed price, or I think, and within a period of time.
So what is K from your?
And key here,
Strike
It is strike price.
Yes,
yeah.
yes. Thank you. Well done. It is exactly strike price, and maybe you remember Nasdaq site, okay? If you wanted that, I show you. No?
You remember about the site?
It's not mine, or it's mine. All. No, yes, it is.
It's probably your, I don't know.
Oh, I don't see. Okay, sorry, maybe I need playing music. It's interesting because okay, sorry. It was interesting. But it seems like it was my music, yes. Okay. So very, very quickly, quickly about strike price. About strike price. So Nasdaq. Yeah, Nasdaq. First we search for company. Not, it's like not Google, yes. Maybe other. Not this, it's interesting. Go. This alphabet and we can have a look historical first. Yes. And after that, option chain. Option chain. So you see, first we need to choose the data. The data maybe November, and you see this column, and it means strike price. Strike price, and we denote this like K. K, strike price. So this is column. It is our strike price for this data, November. And left side it's call option, and right side it put option. Okay, call, and this for put. So we need to distinguish what is strike price, what is the premium price, this premium price, yes, premium price for call and for put, and what is the market price. And market price, it is like price for today. And what is price for today? It is this, okay? Distinguish these three prices. It is market price, this strike price, and this premium for call option. Okay, we return to our presentation. Not this, maybe this. Okay, so the payoff for call option, it is the difference between the market price at this moment, yes, at this moment it is SU. In this example, it is like S multiplied to U, or S multiplied D, yes, it's market price. And there are strike price, K, and we win if the market price is more than strike price, yes. So this, it is our profit. So we get this profit in what case? In which case? If SU more or less than K. Positive profit.
More.
Okay, thank you. So if S multiplied to U more than K, and 0 if SU less or equal K. Okay, so it is about our profit, about payoff function from call option, yes? But this, it is two scenario, it is payoff function from the portfolio. And our idea is that the profit in up scenario should be equals. So in up scenario, this, you see, equals this, yes? In down scenario, the same. The payoff function, you see, this equals this 0. So you see that the system of linear equations, and the solution of this will be theta 0, theta 1. So it is coordinates in our portfolio. How much we need to have like cash, it is or borrow or invest, and how much we can have the stocks. What is number of stocks? So we need to solve this system to get this vector, and after that to compute the wealth of the initial investment portfolio. Okay. Is it clear, this idea?
Yeah.
Yeah, but okay, but what was our problem? What is problem for today's lesson? To learn the third way for what? Yes,
About options.
yes, about how to find the premium of option. Yes, fair price of option.
Yeah.
And what do you think? We don't need, or we don't know now. Yes, just it looks like something about replication approach, but we don't understand how it's connected with the option pricing. Yes, yes, yeah. I didn't say about it nothing. Okay, but I would like first to consider the example. And example the same, yeah. You remember, like it was this, yes, K and C, yes, and you remember that this premium of the fair price of call option was 2.757. It is by probabilistic approach. It is by pricing by the absence of arbitrage, 2.757. And now, okay, now we have the same example. So initial price 100, and the price for the final moment to the moment 1, we can say that 107 and 93.46. And it is, if you want, you can multiply it 100 by u, yes, as u as d, or it's given already. And we have k 102. So our idea, replicating portfolio, we create portfolio theta 0, it is cash, and theta 1, it is amount of these stocks, these shares, exactly this, yes, yes. And at the moment t equals 1, at the moment t equals 1, or what we have a pay function from the cash, yes, cash multiplied 1 plus r, yes, it was how much we have at the end of period. For example, 1 year, 1 year. If we put in your bank account theta 0, so at the end of 1 year we have theta 0 multiplied 1 plus r. Do you agree? Yeah, you know about, yes, yes, okay, you know about this. So and it should be in up scenario and in down scenario, because it's not risky, yes. So it's for up scenario and it's for down scenario, doesn't matter. what is about stocks? About stocks. At the end, we have this amount of stocks, 2, 3, 23, doesn't matter. But at the end of period, you see that the price of stocks 107. So we have 107 multiplied the number of stocks. If we have 2 multiplied 2, if we have 10 multiplied 10, yes, and it is in up scenario. But in down scenario, we have this, yes, we have this from stocks. And our idea, it is that we need that this Pio function is equal the Pio function for call option. But call option, you remember, if the k equals 102, so the Pio function is, yes, you remember, in up scenario, it is how much? Alexandra. It's very easy. Olena. Okay, what's your function for call option again? Artem.
S minus K, no, plus,
Yes,
like,
yes. S minus K, and it would be 107 minus 100 and
minus 102.
yes, so it's 5, yes. But at the down scenario,
So it's 93.46.
we win only if the price more than strike price. But if this price less, we don't have the obligation to realize the option. It is
So
like
zero.
lottery tickets. Yeah, yes, we threw into trash. So it's zero. It's zero. Okay. So, for example, if you create portfolio, so at the end of period you have money in this amount in up scenario and this amount in down scenario. But if I don't have portfolio, but I have a call option with strike price 102, at the end of period I have or a 5 or a 0. And we would like that our profit, your and mine, should be the same. This idea. Understand? Guys, understand?
Yeah.
Yeah.
Yes.
Thank you. So you see that we have this system. We from up equation can subtract the down. It should be 0, and 107 minus 93.46, it should be and 5 in the right side it is 5 minus 0, 5. And from this equation we can find theta 1, and it should be this. After that we substitute theta 1 in the first equation and we find theta 0. Okay? After that we can find the wealth of the invest portfolio at the initial moment. Theta 0, it is minus 34.17 plus S1, it is 100 multiplied theta 1, so it is 36, and it should be 2.76. So Did you understand the idea how we can find the fair price of call option? How we can evaluate the premium from this example? Yes, no? Okay, it is just about the initial value of portfolio, yeah? But now I ask you about the fair price of call option. What can you say? Volodymyr, can you say something?
I'm not sure about fair price, but from this system we could find theta 1 and
Huh?
theta 0.
Yeah, substitute, yes,
Yes, yes.
and get this wealth portfolio, yes?
Mm-hmm.
But what's about fair price? Okay, maybe там Alexandra, Olena, Artem. Do you have any ideas?
At this point, no ideas.
Okay, so I need to take you a tip, yes? Okay. The answer in this example, the fair price of call option 2.75. Yes. If we choose other approach, the answer the same 2.75. And now the answer the same 2.76. No, там 17.5f. Yes, it's like approximation. So do you have idea now?
So we have to calculate the fair price, correct? Having the and we have okay, let me remember the formula.
So if we compute the wealth of the investment portfolio at the moment t equals 0, initial, yes, initial. So if we know the initial value of portfolio, so it is this value coincides with the fair price of call option, no, or call or put option. Okay. So it's like a rule. we deduced this rule. Okay. Do I need to repeat this conclusion? No? Yes? Volodymyr.
Could you repeat, please?
Okay. So if we use a replication approach, we can find the coordinates of the investment portfolio. After that, we can compute the initial price of this portfolio. It is like wealth of the invest portfolio at the moment t equals 0. And the rule is that the investment value of initial portfolio, it is the same like the fair price of call option. Okay?
Okay.
Why? Because we replicate this like in call option. Yes, we used this PIO function of call option. So exactly for this full option, call option, we have the premium, the fair price. Okay. So yes, it is like your conclusion. And the interpretation. So, initial portfolio 2.176 means how much we own in initial moment. So it is your own money in your pocket, 2.76, and you can you can buy a call option for this money, yes? For this money, because it is like premium. And if you buy the call option, so at the end of period, you have how much money? Do you remember? If you buy call option with the strike price 102, at the end of period, how much you have your own money? 500, yes, 500, because it was your own money, yes, your own money. Okay, it is from one side. From other side, for investor portfolio approach, this money means no, how much we own. The portfolio with these coordinates means that we borrow this amount from a bank. So we had 2.76, and this we borrow. So we had this money, and we bought this amount of stocks with initial price 100. Yes, it is. You see, 0.34 multiplied 100. It should be exactly 36.93. Yes. Okay. Yeah. So it is how connected this and this. Yes. At the moment t equals 1 for the up scenario. Stock costs 107. And but how many we have these stocks? Only this amount, yes, this amount. So we multiplied amount by price, and it is price for in up scenario what we have. But we need to repair this sum. Why? What do you think? Why we need to repair this? Who understood this? Why we need to repair? Olena, Alexandra?
Can you go to the previous slide, please?
Yes, I can.
Why do we multiply? Correct? By 101. Why do we multiply? Because R is 0.01. So we multiply by the rate.
I think
Or
it is because of t equals 1, so some period of time like is gone, and we need to calculate so in t equals 1.
No, so yes, it is like 1 plus r, yes?
yes.
1 plus r, but where this from? Where is this from?
It is calculated like here.
Yes,
We borrowed it.
yes. So from t equals 0, this we borrow, and this amount, how much we bought, да? Buy these stocks. At the moment t equals 0, we need to repay because we borrow, yes? So this sum, we multiplied 1 plus r, and we need to repair this sum. So in up scenario, we have 39.51 euro, euro and subtract this our borrow, what we borrow, so it is just 5. At the down scenario, stocks cost this 93.46, and we get this amount of euro. Yes, because the number of stocks this, and we need to repair the same. So it is 34.51 minus 34.51, it is 0. So the result is like the call option. Yes, it is like the payoff from the call option, 5 and 0. 5 and 0. So really, actually, we construct the replication portfolio. No, maybe it's not very, very simple, but it's easy. Yeah. Okay. Okay. So we have some time, and we can to solve the other example. Okay. So stocks, we have that S05, and its initial moment t equals 0. But at the t equals 1, we have or 20 divided by 9 or 40 divided by 9. We are mathematicians, so we write what we want. Okay, and interest rate is 1 divided by 9. No, okay, yes. And we don't have call option or put option. We have the derivatives with this payoff function. It is some strange, we don't know what is kind of these derivatives. But anyway, we have this. And we would like to find the fair price for a given derivatives. We can use 3 approaches, yes, but let's use the last approaches. It is like a replicating option by investment portfolio. Okay. So the idea, do you remember idea? We need to create the portfolio, and we have only 2 coordinates. The first coordinate theta 0 and the second coordinate theta 1. And now we don't know how much theta 0 or theta 1. Okay. We can compute theoretically the wealth of portfolio at the initial moment 0, W0. And what I need to write?
It is theta 0 plus theta 1 multiplied by s
And
0.
do you know S?
It's 5.
Yes. So plus 5 theta 1. Yes.
Yes.
Thank you. Well done. Okay. And what will be at the moment t equals 1 with portfolio? What will happen? Yes, with portfolio at this moment in the up scenario and in the down scenario. From cash, what will be? If we have at this moment this amount of cash, so at the moment t equals 1, can you compute how much should be the amount?
And we should find like theta 0 and theta 1. I just didn't get about the t, but I think that we have to make a system like of equation, but not
Okay.
equations, and then to solve it, try to solve it.
No, okay, please say. Tell me. Theta 1.
So first system is theta 0 multiplied 1 plus r plus theta 1 multiplied by
1
the
plus
up.
r we know it is 1 divided by 9, yes?
Yes, we can really we can just
Okay,
substitute
okay.
it.
It's in up scenario, yes? With your cash,
Yes,
will be this. But
yes.
what is about stock?
Then we take the up, the s up.
Mhm.
We take the theta 1 and multiply it by 7, not 7, but not 7, by 20 divided by 0.
Yes, 20 divided by 0. Yes, you're right.
And it equals 7.
Yes, and it equals 7 because it is what happens with portfolio in up scenario, and it is how much with call option for your function 7. Yes, yes, you're right. But what's about down scenario?
And about down, it's similar. We take theta 1, multiply now 1 plus r, it is the same. So
Mm-hmm.
it's like, yes.
Mm-hmm.
And then we add theta 1
Mm-hmm.
multiplied by 40 divided by 9, the down scenario.
Yes, because it is this down
And
scenario.
it equals 5. Oh, not 5, sorry, 2.
Mm-mm. Maybe
It is,
it should be this 40 divided by yeah,
yeah.
because maybe it's my fault. Yes, maybe this
Oh,
40.
can you see? No, I think it was correct the first time.
Yeah.
Yes, because we have the up scenario, which is 20 divided by 9, and the up scenario f is 7.
What is more?
Um, hmm. I'm just so you say that condition is not correct.
Yeah, I think maybe it is when I have written this, I
Maybe, okay.
I missed it because it's 40, it's 20. Mm-hmm.
Yeah, it's logical. Yes.
It's
Okay, sorry.
logical, yes.
Then it's correct. Yeah, then it's correct. Then in the first equation of the system, we have 40 divided by 9 and it equals 7. And in
Mm-hmm.
second equation, it's 20 divided by 9 and
Mm-hmm.
it equals 2.
Yes, you're right. And from this equation, we need to find theta 0 and theta 1, yes?
Yes.
And if we know these values, how we can find the fair price of call option?
Then we substitute it into the W0.
0, yes, yes. Mm-hmm. And yes, yes. And the values of portfolio coincides with fair price of call option with premiums. Yes, well done. Thank you. Thank you. And okay, and maybe we need to repeat the first approach, the risk neutral approach. Risk neutral approach for this example. So
Let's try.
Yes, yes. So we need to find the risk neutral measure. Yes, Q1. No, or Q and one minus Q, or Q up, Q down. Oi, minus Q. We need to find risk measure which provides that mathematical expectation for the payoff function respect to Q. Oh, no, not for them. It is C. Sorry. Clear. Okay, don't worry. So we need to find the probability measure risk neutral Q and 1 minus Q that which provides that the mathematical expectation respect to Q this discounted profit, yes, discounted profit equals 0. And what does it mean? So if this 5, this 40 divided by 9 and 20 divided by 9. So from this we have the equation that it doesn't matter if we invest your money in your put account or in stocks. So if you invest your money in your put account, so it will be at the end of period how much? 5, yes, and at the end of period, no, 1 plus r. We repeated already, but mathematical expectation for this will be how much? 2 values and 2 probabilities. So please, Artem, 2 values and 2 probabilities.
Yes, it is no 40 divided by 9 multiplied by Q and plus 20 divided by 9 and multiplied by Q 1 minus Q.
Yes, well done. Thank you. Nice. So from this equation, we can find Q and 1 minus Q. Yeah? But
Yes.
how we can find the payoff? No, там payoff I don't know. No, how denote? Okay, see. According definition, it is discounted mathematical expectation for the payoff function. And that's our payoff function. So it should be 1 divided 1 plus 1 divided by 9. And mathematical expectation, it is how we can find for this. No, like this, yes? Artem.
No, yeah, it's like 7 multiplied by Q and plus 2 multiplied by 1 plus q, or 1 minus q.
Yes, you're right. Nice. Thank you. Okay. So it is like the second approach. Thank you. Okay. Summary. We start with the idea to model the financial market. We assumed the financial market consists at least of three components: riskless asset, risky asset, and derivatives. For model risky asset, we assumed the efficient market hypothesis. Yes, it is hypothesis that there are risk neutral measure that provides that discounting profit is zero. After that, we consider the one period binomial model. It is model where there are only two scenarios. The probability space consists of only two outcomes. And we need to know the initial price of stocks, interest rate, and the prices for stocks at the final moment, or the UND. And from probabilistic approach, we know the condition of the existence of risk neutral measure. Do you remember what is this condition? If one period binomial model S and this S multiplied to U, S multiplied to D, and we know S, U, D, and R. So what is this condition that a risk neutral measure exists?
It's like S there should be lower than 1 plus R, and 1 plus R should be lower than SU.
Without S.
Oh, yeah, U and
D and U.
like.
So every time we need to check if this sum will be more than D and less than U. Okay. And this condition provides that the risk neutral measure exists. But sometimes it should be that it is not unique risk neutral measure. But in the case if this measure unique, we have the full market. Okay, so it is probabilistic approach. There are arbitrage approach. It is we repeated for today, yes, that if we have profit without the initial, it is situation when we have profit without the initial amount and without risk. And replication approach, it is when we build the investment portfolio, and we would like that the value of portfolio at the moment t equals 1 replicates the payoff function of option. Okay. Okay. That's all for today. You can write about all this in these two handbooks, and thank you for your attention.
Thank you for interesting lesson.
Thank you.
Yeah. I'm very glad if you looked it. Okay.
And I also wanted to ask, we have only lectures and we don't have like the practical lessons
Okay.
today left, yes? Only lecture.
Yeah, we have practice lesson.
Okay. So
Okay.
practice is
So
at
it should be
which
at,
time?
yes, at 3 p.m.
Okay.
Okay. So we will meet. Okay.
Okay, then see you.
See you.
See you.
Bye.
See you. Bye.